Tosha Global Analytics. Please like and subscribe.
Greetings, salutations, and howdy to you all. I'm KT with Tosha Global Analytics. As always, I want to remind you that Tosha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. I wanted to cover something. I recently did what I called an office building case study, and I've expanded upon that with a number of other videos concentrated on commercial real estate in the office market, primarily how it works on the property level, which is what we call street level because that's where people interface with the real estate market daily. And the collective impact of the street is what ultimately drives the economy as a whole. But just to put this in context, I underwrote, meaning I financially modeled for acquisition around 200 billion, or maybe I should say 1/5 trillion. It sounds more impressive, maybe, but I underwrote for acquisition around $200 billion in multifamily and office properties since 2013, as well as finishing my master finance degree at Harvard. And so I have the experience, the data files, and the education on the subject, and yet none of that is really necessary to see the disaster brewing for the office property market, commercial real estate in general right now. So this video is going to tie into the office building case study that I've already published, but it's also going to provide some real insight into what the trends are and the challenges that owners of these properties are enduring. Again, what's this really mean at the street level? Okay, so here's some stats from recent items in the news to put it all in context. I've not included the news on the most recent bank failure, but if those continue, these stats will get far more worse than they are. But here's those stats. Okay, so we've seen the percentage of U.S. office space as vacant go up basically double since before the pandemic. And right now it stands a little greater than 20% overall. By the way, I'm going to circle back to that in a little bit because some of the definitions matter, and so the context sounds contradictory at times. But anyway, the amount of office assets with debt maturing by the end of this year is 189 billion. And the amount of office assets with debt maturing in 2024 is about 117 billion. So that's about 310 billion right there. Looking at some quarterly stats, the value of troubled office assets Q1 to Q2, it's up 36% in 3 months. The total value of troubled U.S. office assets right now is only 24.8 billion, but the additional office asset debts that are in distress right now is another 162. Whereas compare that with total value of troubled U.S. retail assets is only about just shy of 23 billion, and hotels about 13.5 billion. By the way, the bankruptcies, defaults, etc., that's primarily happening in those tied with office properties. I wanted to show some annual changes year over year. Office asset prices, the office buildings, down 27% year over year, whereas all commercial assets combined, including the office assets, 12%. So that's a huge change. So we have some general stats, but how about how the firms are navigating this? So it gets a little bit more specific. Well, here's a few more things before I cover those. So before I highlight those anecdotal examples, let's call them that, here's some other things. Why do some of these stats seem to contradict each other, where vacancy is concerned specifically? And I referenced that a moment ago. So here's something to remember with vacancy. There are a lot of nuances within that conversation. A space can be legally leased and some sort of rent being paid, but it is not being utilized as it should be. So the rent, if the rent is fully paid in accordance to the lease, that does not necessarily mean the people are filling that space for a full work week, especially now that working from home and remote work has become so popular. Sometimes only about 50% of the staff is occupying the same space that was 100% occupied before. So there's utilization issues. Card swipes measure activity coming and going, but a space that's 100% occupied with only about 50% of the staff there within business hours every week, and you have this underutilized space. At some point, companies are going to accommodate that. But the reason we have terms like potential rent, effective incomes, they exist for a reason. These terms all mean that whether a space is leased and occupied or unleased and vacant, the reality is not really black and white like that sometimes. So, the nuance really matters. So, with the changes that have already been taking place, as revealed, via the stats I'd already shared, it seems the economy will be starting to react this quarter, as the conference board had recently predicted when they forecast the U.S. recession to begin this quarter. So, we'll see on that. But anyway, so here are those anecdotal items expanding upon the stats. So, J.P. Morgan Chase charged off $100 million in loans last quarter. It since also increased its cash reserves against those additional loan losses by about $389 million due to, they called it, updates related to certain assumptions related to office real estate. So two relateds in that brief sentence. Here's another one. Starwood Capital Group has defaulted on a $212.5 million loan on an Atlanta office tower. Starwood and the lender are said to be negotiating right now. Here's what the Starwood CEO had to say about the market in general. He says his name is Barry Sternlicht. He said in an episode of Bloomberg Wealth with David Bernstein that commercial real estate is in a Category 5 hurricane, thanks to the U.S. Federal Reserve's relentless campaign of interest rate raises. He further adds, it's a blackout hovering over the entire industry until we come, or get some relief or some understanding of what the Fed is going to do over the longer term. So we've got a few more stats from other sources. Across the U.S., the proportion of vacant office space has reached a record 13.1% static. Per the National Association of Realtors, but that includes medical offices, by the way. So that, of course, is not the same as like your typical, downtown professional office space. And by the way, in 2018, 2019, the average vacancy rate was about 9.5%, again, including those medical offices. And of course, that would be based on legal occupancy associated with leases. And since the beginning of 2022, the rate has hovered between 12 and 13%. So it's now broken over 13%. So it's actually moving in the wrong direction. Just so you can kind of know, Manhattan's vacancy rate right now, it's 22%. Again, that's per active leases. That's not underutilization. So those stats, many of them look grim, and the fact that values are falling is an issue that will become more corrosive to firms, banks, or alternate lenders as well, and eventually to the economy. So buckle up, buttercups. I have plenty more, but before I cover that, please like, subscribe, and ring the bell so you can continue to help us grow this channel. Thank you very much. So another issue that it isn't addressed much, downturns in real estate, they also happen cyclically. And downturns tied to real estate cycles are typically more protracted and challenging for the economy than solely a conventional business cycle recession alone. Business cycles, they say it's about every 5.5 years, whereas real estate cycles, they say it's about every 18 or so. So that makes, there are usually 3 business cycles within one real estate cycle on average. And those tied to real estate especially can be really beastly, like the Great Recession was. There's several books written on real estate and the real estate cycle, and even a truly astute quarterly publication that tracks the real estate cycle for common commercial property types. I'll share a bit from that so you can kind of understand the implications here. Again, the reason to mention this is that any recession we endure in the near future is going to be deeply connected to a real estate market reset, as it's very clear already to everyone listening to this video. So whether the real estate issues cause it or worsen by it, the real estate challenges will take years to resolve. It's going to be a bit to really filter this through the system. So our real estate cycle peaked in 2022 with the Fed rate cycle reversing the easy money policies, and by the way, the last cycle peaked in 2006 or so nationally. So that gives you an idea that we're within a year or so, or a couple of years of when it should happen. Now, the drivers of the real estate cycle clearly peaked in 2022, but the property sectors and individual markets aren't completely synced. There's some areas that had not really seen any kind of peak until late 2022 or early 2023. Now, some are a little ahead, some are a little behind the overall cyclical trend, but by the way, also the changes may not move completely linearly, like how prices in the housing market seem to recover in the 2023 selling season, but already they're starting to show some weakening again. That's what I mean. You may see some momentary changes from a general trend line. So the trend is not the friend for the housing market, just like it isn't for commercial real estate. But as with all economic tide cycles, the reversion to the mean or the median will eventually win. And that's what's happening in commercial real estate, especially with office properties. So this is early in the real estate recessionary phase, basically, is where we're at using the four-phase model. Just to put it in context, the four phases are: phase one is recovery, phase two is expansion, phase three is hypersupply, and phase four is recession. Now, what may not be readily apparent based on the names, the actual peak in values and prices comes at the transition point between phase two into phase three. And the decline in prices begins in phase three and ends during phase four. And it generally is plateaued or starting to move back up before it moves back into recovery. And recovery is really the trigger point where it starts to genuinely move back up. So let's see where the market was in Q1 for here in the U.S., since that's the newest data we have is Q1 2023. But before I cover that, please like, subscribe, ring the bell to help us grow the channel. Again, I appreciate that as always. So, okay. So based on the tracking of 5 property types, that's retail, office, multifamily, hotel, and industrial, we see generally where we are within the comprehensive cycle. So retail is in the latter portion of phase 2. So it has not technically peaked yet. So it's within the expansion phase, as is industrial properties. The hotel sector is in the earlier portion of phase 2. It's catching up. Office is in phase 4, recession, and moving into phase 1 in some places, recovery, as they are already well into the decline. So it's ahead of everything in the general cycle. And we are at or past the peak for multifamily, with some areas projected to be near the end of the recessionary phase, and therefore, supposedly bottoming in value pretty soon. So with an average of about 18 years or so in each real estate cycle, we're 2 to 3 years from everything bottoming and starting into a trackable recovery. And until everything does, you won't see really significant progress. So we've addressed what's happening to the office market, the anecdotal examples of how we some are addressing it anyway, and the real estate cycle in general. And now the last thing is what this means at the street level again. So, here's some street level challenges. Potential rents have not really fallen, but they likely will soon. Please reference, some of my other videos where I showed how the number associated with rental rates didn't really change going through even in the heart of the recessionary stage. But the expenses the tenant actually paid shifted from the tenant to the owner as the Great Recession progressed. So the rental rates, stayed about the same, say $20 a square foot or so, which was what it was then. But the vacancy allowances, they end up doubling. And then, so that means less effective income. Expenses are increasing due to inflation, but owners are starting to pay a greater portion of those expenses, and any expenses they happen to have are going up. So, unleased space still has expenses. So, when it's not leased, the owners are paying that. Spaces that are leased without certain costs being included in the tenant's portion of the expenses. If it's not triple net or double net, some of those expenses definitely shift over to the landlord or the owner. And so you see the issue here. Owners' expenses are going up. Values are coming down for a combination of reasons, but all this means that the properties will not be financed for as much as they could have been a year and a half ago. And if the building has plenty of equity, then great, but not every owner has that. So as we covered in the main videos, and later we expanded on the process when I did the capital stack videos and what have you, there are options and methods to navigate this. The latter video demonstrated how the typical owners might work out internally, and to do what was necessary to manage the damage. All based on experience that I received during the past downturn. So I hope you found this insightful. Please take the opportunity to like, subscribe, and ring that notification bell. Also, please check out our other videos and resources, because those would come in very handy and expand your knowledge base. So thanks for joining us for the journey today, and I will catch you in the next video.
Tosha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.